be the trigger points for the markets, and how is it that you as an investor should be positioned? We've got Kenneth Andrade, founder and CIO at Old Bridge Capital Management, joining in on the show right now. Kenneth, hi, morning. Great to have you on the show. Kenneth, besides the attempt that we somewhat made last week and finally made it to that 25,100 mark, this has been such a range-bound market. What are the tailwinds and headwinds you think are currently at play for us?
The headwinds is pretty much well known. So there's not much to speak about it. But I think in terms of the tailwinds, we've got the markets remaining at this level for now approximately a whole year, right? And that's moderated valuations to a certain extent. Second, corporate India has now probably started using its balance sheet to expand its global footprint. So India's indexation to the global environment doesn't seem to be very large. It is not large. Okay, and the best way to actually do that is either export yourself out of the problem or go and acquire acquisitions. Technology has been doing it for a while. Now you're seeing manufacturing and some other industries also doing well. So what we've been waiting for a period of time is corporate India trying to put its balance sheets to work, and I think that's about where it is starting at this point in time. So valuations normalizing, you getting capital getting put to work, and the broader environment, more specifically the Indian environment. I think the government's doing what they can to kickstart the domestic consumer environment. So I think all of that is going to help us put this together.
So Kenneth, as an investor, what is it leading to? I mean, one is wondering that for the next 2 years then, what should one's portfolio tilt be? I mean, should it continue to be with consumption, and especially given the government's focus of late, or should your tilt be more globally aligned towards AI, tech, etc.?
So if I put it together and go back into a little bit of corporate history, you need domestic cash flows or companies which have a reasonably strong footprint as far as the domestic environment is there. Use those cash flows to expand yourself globally. So India is in that position wherein you've got about 3.5% of world GDP. And now to grow yourself out of that 3.5 GDP upwards, you've got to take market share from the rest of the world. And despite whatever has been happening on the trade realignment bit, I think we're pretty much we pretty much find ourselves reasonably strong in a few verticals that are out there, and the focus necessarily needs to be on a large part of those verticals. Okay, over the longer term, I think we've come back fairly strongly in everything that we've been that has not worked for us so far. I mean, in terms of quality of manpower in the manufacturing business, we've seen how IT has re-engineered their entire employee strength to go out and become significant globally. I think that's what's starting up happening in manufacturing and other industries. So I think that's what we need to do. If you have to look at where we are, we need to focus on companies that are strong in the domestic environment, and also companies that are now expanding their balance sheets and their footprint across the entire world.
But along with that, Kenneth, there's a big GST reset announced just off late, and from 22nd of September, we will see those resets happening. Help us understand, how are you playing the consumption story, and post this announcement, have you made any fresh additions in any pocket, if you can talk to us about? Because I see very interesting names like Maruti and all. They are one of your top investment ideas for now.
What happened over the last couple of weeks, you basically stabilized the domestic environment through by stimulating the consumer footprint, by stimulating the consumer. So this quarter expected to be fairly buoyant. I think both from a lending perspective into consumers as well as from consumer-led businesses, specifically autos, or specifically discretionary consumption. I think that will be reasonably strong. But we need to see how these companies can find pricing over a period of time. And I think that is relatively critical to what plays out for the remainder part of for all of 2026 calendar year. So if we've been able to get pricing as well as volumes, I think it's a new reset for consumption. But if you get volumes in absence of pricing, 2026 is going to be relatively moderate. So it's a litmus test. This quarter is going to be a litmus test. I mean, pricing determines how stocks or valuations should trade. And if you get pricing back, obviously 2026 should be reasonably structural as far as the consumer economy is concerned. For now, I'll moderate my expectations for 2026. But this quarter, we're looking at a relatively strong consumer-led economy till the end of this calendar year.
Okay, and Kenneth, the last time we interacted, I remember you were positive on metals and you did like that space. You continue to hold that view given so much has been happening on the tariff front in terms of the global commodities, and within base metals, what is looking good right now?
If you take all the companies in metals in India, right, they have some significant advantages in terms of how they, in terms of cost advantages that some of these players have. And they have relatively high capital efficiency ratios. A lot of that is now determined by the fact that they have a reasonable amount of protection in the domestic environment. So profitability should be relatively okay for a bulk of these businesses. The second big change, I wouldn't say the big change, but what's ongoing with these companies is that they are investing significant amount of capital to expand their businesses. So there are two things that are going to happen. Capital investment is going to continue, and is going to continue at a reasonably strong pace. None of these businesses need external capital to fund whatever they're doing right now. So incremental amount of cash flows coming out from expansions is going down to pay back debt. And you've got individual businesses that are now looking at rationalizing costs and bringing costs down. They're already running at a reasonably low cost base, but a significant amount of these companies will now cut costs. And when you do all of this, the cash flows increase, and you will be able to see a reasonably strong balance sheet going into the next 2 or 3 years. So we're relatively constructive on that space, and also if steel prices hold up, I think we should be in, not just steel, but metal prices hold up, we should be in for a reasonably stable environment for all of these companies going into the balance part of this decade.
Okay, and Kenneth, we were just talking about consumption before this and how this entire GST regulation, the cuts coming over there, also the liquidity and front loading via the RBI, that's given so much of liquidity into the economy, so much of a boost to the consumer sentiment. And now with the festive period underway, do you feel the tide could be changing for some of these FMCG staple companies? Because at least on ground, that is what we're hearing from management.
So I did mention that consumer discretionary, especially in the automotive and the appliance businesses, should be relatively stable and see reasonable amount of volume growth coming in there. I may not be very constructive into the non-discretionary part of the market. So we have to wait and watch. We tend to believe that this quarter should be the litmus test for the consumer economy. If they are in a position to get volume plus pricing, I think it's a structural change. But if they're just getting volumes with the absence of pricing, 2026 might not be such a great year for a consumer economy. So we're in a wait and watch. Our current positions are largely linked to discretionary consumption and not so much to non-discretionary spends.
Kenneth, I see in your latest fact sheet, your focus fund is sitting at 11% cash, but this has come up with a disclaimer that it's not a cash call. It's due to the higher inflows that you have seen towards the end of the month. Help us understand, how do you plan to deploy that? Will you be planning and looking forward to deploy that in a staggered manner? And for our viewers, if you can help us understand the key sectors that you are looking at closely right now. I know we have talked a lot about metals, consumption and all, but what's making to your top list?
So it's going to be a little bit more of the same. We'll just add another one business over the course of the next couple of weeks. But it will be largely in the domain of where our current positions are. If you look at the portfolio constructions, I think we've got about 13% in pharmaceuticals, and metals is about 8%. Technology is closer to about 9%. Financial services about 5%. Automotive and automotive parts will be about another 9% of the portfolio. 5% will be in real estate, another 5% in aviation. So a mix and match. It's fairly a diversified portfolio with a reasonably strong focus on businesses that lead their category or their segment. I think the cash that is sitting in our portfolio will be a little bit more of the same and not something significantly different from where we currently stand. It will be between 22 23 stocks, and the focus fund will be between 22 and 23 stocks, and very much in the domain of what we expect the environment to move towards. While saying that, into 2026, we're fairly aligned to the fact that the significant change in the trade environment should normalize itself. Okay, and most of the Indian companies that are there will continue to dominate and actually stabilize operations and go back to historical growth levels.
Okay, Kenneth, great to have you on the show and good to gather your views as always.
Thank you very much.
Let's just quickly see where the market has settled in at, and it continues to be a